Hello, everyone. First of all, a warm welcome to all of you to join us, for this webinar on Friday evening. All of us aspire to make, returns like 10x types over 10 years. It is an aspiration, but hardly at a portfolio level, investors are able to experience that. There are hardly any funds or portfolios over, I would say, history of last 10 years, or even if one, goes back and sees history of 20 years, that would have delivered like 10x type returns over a period of 10 years. 10x type returns basically translates into like 26% per annum. To have that, sustainably is like a skill set. It requires a lot of discipline, experience, and that is the context of this webinar today, where we are wanting to understand how to create sustainable risk-adjusted alpha in the space of small caps. Because obviously, to get such a higher return, one has to invest in the space of small caps. But obviously, space of small caps has a lot of risks and many failures, and hence, not just returns but risks also matter. And we have selected Mr. Jaipuria for this webinar because over last 3 years, his strategy has been actually doing excellently well. In fact, it's number one strategy, and recently we did awards in association with IIM Ahmedabad, and Valentis Advisors, which is founded by Jyoti, has been kind of one of the winners. So just to kind of talk about Jyoti, he brings with him around 2.5 decades of experience. He's MBA from IIM Ahmedabad and has been throughout working in various assignments, pertaining to, I would say, investments. And over last 7 years, he has been managing public money since 2016. And over years, Valentis has been building its name. Without taking much time, I would hand it over to Jyoti to begin with his presentation today. And once presentation is over for first 30 minutes, then we'll take questions and answers. Over to you, Jyoti.
Thanks, Kamal, and great to be with everyone here. So essentially, what we will do through the course of this presentation is three things. First is why one should invest in small caps. Second is why people get scared of investing in small caps. And then the third will focus on how we go about it. So, one way to invest is not probably the only way, the way we like to go about investing in small caps. So first is why to invest in small caps. So it's very simple because small caps can give, like Kamal said, a better return than what the large caps can give. So, on this chart, I've just taken the index, the Nifty and the small cap index. So if you see this, basically, the small cap index has given a much higher return than the Nifty. If you had put 10 crores, 10 years ago in the Nifty and you'd put 10 crores in the small cap index, then the small cap would have given you much better return. We've taken this as on end of 22 as well as at the end of 21 because 22 has been a very bad period for the small cap funds. But even then, the small cap returns are still way higher than the Nifty over the 10-year period. So one is it's simple, like the index itself gives you the higher return. But second and more important is alpha is much higher than in a small cap than in a large cap fund. So one is the index give you higher return, plus most funds will end up giving you much higher than the benchmark return in a small cap. It is a struggle to really beat the index in a large cap fund. So generally, the expectation is that you'll be able to do a much higher return here. Like even if we just look at, and this is our returns, but we could take anybody else's returns also. Well, since our inception, which is like nearly 6.5 years, we've done an alpha of 11%. So, that's the sort of alpha we've done. We obviously started at a very bad time because the index had done like just 7% return since we started the fund, because we started like a month before demon. But even then, the returns which we generated are like quite high. So this is like the return is the simple thing to think about why you want to be in a small cap. Now, why you don't want to be in a small cap, or what stops people from going in a small cap, it is the volatility. And that volatility is the nature of the beast. There's nothing much you can do about it. So first is, if we see this, I've plotted here the returns every year in the small cap versus the large cap universe. So there are two, three things which stand out. One is, typically the small cap will do better than the large cap when the market is going up. It will fall more than the large cap when the market is going down. So it is like, you want to be in small cap in a bull market. You don't want to be in a small cap in a bear market. It's just that, to figure out when there's a bull market, when there's a bear market is always a problem. The second thing which we see is generally, and there have been only one occasion which happened in 18 as well as 19, where the small cap underperformed the large cap for 2 consecutive years. Otherwise, if you see the trend, it is like, if you have 1 year of underperformance of the small cap, typically they'll outperform the large cap in the next year. And so, like we've had 22, which has underperformed, the small cap has underperformed the large cap. Just by history, you probably should have outperformance of the small cap versus the large cap in the next subsequent year. So, that's one important thing to think about, that you have to invest in small caps when it is out of favor. Don't invest in it when it is in favor. The third is, the volatility of returns are high, much higher than what the large cap returns are. There's some periods where you'll get a huge amount of return coming in small caps. And when you try to time some of these, you end up missing those years because you never know. So, like if we look back since we started the fund, 2017 was one calendar year where the returns were humongous. 18 and 19 were horrible periods for small cap. And then 2021 turned out to be a huge period where small caps did very well. So, in some sense, you'll find your returns being very, very volatile. They're not like the steady returns which you want, but you'll get them. There will be drawdowns. So, one of the biggest factors which worries people a lot is, okay, I'm seen a drawing down. I've seen, my portfolio being down 30%. I don't like it, because if a 30% down, then you need 40% plus return to catch up with it. But it does happen in small caps, because typically when you get these few years where they've done well and they're there in the charts, the returns are like, very, very high double digit returns which you'll get. So these are three things you have to remember. Volatility will be there, but you're, playing that volatility for the high return. The next thing we should remember is liquidity. Liquidity is a challenge in small caps, and it will continue to be a challenge in small caps. So that's one reason, like, people like us always keep thinking that if we do a small cap fund, how big can we make it? At what point do we shut inflows in it? Because otherwise, liquidity will keep swamping us. So funds approach it in two ways. One is, funds approach it by keeping the size small. Like, for example, our size is small and we don't think we can make it a very large size. The other way they approach is increasing the number of stocks in the portfolio. So typically, people like us prefer having only 15 to 17 stocks in the portfolio. We don't want a large number of stocks in the portfolio. But one other way, if you want your fund to be like a few thousand crores, is then you have 30, 40, 50 stocks in the portfolio. So what that does is enables you to, ensure liquidity is not the biggest challenge, but at the same time, your returns are skewed. They're not skewed. Basically, the returns are very, very minuscule, and there's no one stock which can really determine the returns. We prefer having, I'd rather have a smaller fund size and a more concentrated portfolio, because, once we do all the work in some of these stocks, we want to make sure that we get big bang for the buck. So we typically don't do anything at less than 5% weight in the portfolio. So here, just it was more an example, but we tried to put out that, if we want to, if we have 1,000 crore fund and we want to do 5% at least, we need a 50 crore holding. So how many days do we need to sell that sort of thing in across various market cap of companies? The other thing which everybody gets worried about, oh, small caps are very risky, large caps are very safe. So to some extent, there is some truth in it, because the large caps are much bigger. So one order does not change the fortunes too much. One order cancellation doesn't change it. Same way, when one order comes extra, it does not change it. The small caps by size are smaller, so they can grow faster. That's the reason we invest in small caps, because with their size, it's much easier to grow faster than that. But if you think of small caps as risky, it is not necessarily risky. And here again, what we did was we just put out some of the stocks in the auto sector, starting with Maruti, which is like, the largest company, and some of the ancillaries. So if you see here, like, and if you look at some of these parameters at ROE, which, determine, okay, is the company good, sustainably good or not? Look at the debt equity for them, look at the EBITDA growth from them. Actually, there's nothing much to choose. There's no way you can say that some of these companies are inferior to, Maruti in terms of either the ROE profile, or in terms of the debt profile, or in terms of the growth profile. So, just this blanket statement that small caps are risky and large caps are not risky doesn't work. Now the second thing which happens is the large caps are typically more well known. So most people know those large cap names. Most people don't know those small cap names. So if you go around asking people that have you heard of this, the answer will be no, I've not heard of it them, because most people focus on the large cap. So Maruti is known by everybody, but some of the auto ancillaries may not be known by a large number of people, and that's why people get into this perception that the large caps are safe animals and the small caps are not so safe animal. uh, Now the last thing is, I put out this chart. So like I said, is the returns we play the small caps for, but at the same time we have to do a volatility. So this is the price chart of Titan. So this is the price chart of Titan way back in the 90s, when it used to be a small company of 500 crore market cap. Now, if you see this journey over 4 years, if you had bought Titan, in 95, for 4 years, you did not make money on Titan. And there was a time where, Titan was down like nearly 70% from your purchase price if you had bought it on that day. So, we know that Titan has made like more than 300 times the returns after that. And so it's a great blue chip of today. But the small cap had to endure this sort of drawdown before it really became a large cap. And so that is why, the message I want to give you is you'll get bigger returns in a small cap, but you have to endure more volatility. You have to be a patient investor and not, really get psyched out when the stock price goes down. So the next few slides I want to focus on, okay, is this a good time to buy small caps? And typically, for us it is every time is a good time, but is this a really good time? So the first reason why it's probably a good time is that the small caps have underperformed. So like I said in one of the previous slides, if you see underperformance of the small cap, then that is the time to start thinking of buying them. And so small caps have underperformed over 1 year. They were actually underperformed over 5 years, and so probably you're not buying it at like a peak of the cycle. The second is valuations are much cheaper than the large cap now. So there was a time where in 2021 they had become at a huge premium to the large caps. Now they are down to a large discount to the large caps. So to that extent we're buying it at reasonably good valuations from where you can make sustainable money. The third is, if we see last year, the small caps did very badly relative to the large caps because there was a surge in commodity prices. So whenever commodity prices surge, the most of the commodity producers are large caps. Most of the small caps are commodity users rather than producers. So rise in commodity prices hurt the small caps who are commodity users. As the commodity prices are coming down, a lot of these companies which are hurt are probably going to see margins normalizing. Last year, the margins had dipped a lot, so margins will start normalizing. So, these are the three reasons one should look at small cap now. At the same time, there is obviously a lot of global concern now on the Fed, and for me, what could happen to recession. So our theory is that you have to buy, but you buy slowly. Don't put all your money on day one in small caps. Use weaknesses in the market over the next few months to keep adding to your small cap portfolio. So this was, really what we think of small caps. And, the next few slides, I'll just explain how we go about investing in the small cap. Just the approach is for us more useful than, the ultimate return. The returns obviously come because we follow very systematic approach. So, first thing in our approach is we have skin in the game. So basically, I invest my money. I'm always the first investor in any fund which we launch. A reasonable part of the fund today is basically me and my family money. So close to 8-9% of the fund is our money. So we invest with you. We buy the same stocks at the same time at the same price as any other investor in our fund. The employees also are encouraged to put in money, and so half our employees have their own money in the fund also. The other is the staggered investment approach. So, like I said, it's probably getting to be a good time to buy small caps. At the same time, there are a lot of risk in the market. You make money when you invest in uncertain times. At the same time, you don't have to put all your money into stocks on day one. So, we generally do a staggered investment approach. Once we get money, we buy very slowly. We typically take 2 to 4 weeks to deploy the money. Times like this, we are telling investors we'll probably take 8 to 12 weeks to deploy. So the whole idea is there could be dips along the way, there could be some correction, and we will do it. The third thing which I want to just highlight is there are times where small caps become very overheated. So, we generally don't keep cash in our portfolio, but at the same time, if we think valuations have reached a very, very absurd stage, they are very, very demanding, we may go and take some cash in the table, sell some stocks, and sit on cash and do nothing for some period of time. So, for example, in between September and October 21, most of our portfolios were fully invested. We went and sold 15% and sat on cash for 15%. So it's not like we have some magic wand there. We did it at the peak of the market or anything. Markets were actually higher in Jan 22 compared to when we sold our position. But it was something that we were willing to. We said that the risk reward is not very attractive at the moment, and we are happy to sit on like a bit of cash in our portfolio in case we get a big drawdown. Then we'll want to invest that. So, for us, there are four principles which we use to invest in small caps and in stocks in general, which may be useful to everybody. So, first is, research. So, our mantra is research, research, and more research. Everything which we do revolves around research and doing deep work on companies. And I think this is more important in small caps than in large caps. Because in large caps, the companies are more stable. There's a lot of secondary research available which you can read. And so, the company's fortune don't swing from here to there. In small caps, there's not much knowledge about the companies available. And for them, their fortunes can swing very quickly with one or two order cancellations or one or two order inflows, which can, work for them. So for us, research is one of the important cornerstone which we do. The second is, we have what I call a three use approach. And the three use means one is, we look for undervalued stocks, which everybody does, whatever way you define undervaluation. But we are happy to look at underowned stocks. We are happy to look at undiscovered stocks. So the idea is we are happy to be one of the first guys to buy a stock. We don't want, the company to have delivered returns and, it's very easy and everybody knows it and ROEs are very high for a long period of time before we buy a stock. We are happy if we can see things improving over the next 2 years to buy a stock. For us, we are always thinking of what's the risk reward in any stock whenever we buy it. Is the reward disproportionate to the amount of risk we are taking or not? We want a totally disproportionate risk reward. I call it asymmetric risk reward for any investment that we make. The third thing is what are we typically looking for? We are typically looking for an earnings inflection point. So basically, you're looking for stocks whose earnings are, let's say, X to become 2X or 1.5X or 2.5X, so that things start, once the earnings start inflecting, typically you will get valuations also re-rating. So we are hoping we can get like a big earnings upside, which drives a return, plus we can get a re-rating on the stock. Some of the other things I skip, we all want like stocks, whether addressable market is large and we think the company is able to gain market share. We think there's some competitive advantage we have. But a lot of the some of the things which these are there in most of the funds which we look at, most investors look at these same things. Lastly, if we think of ourselves, we think of ourselves like a quasi private equity investor. So we are, private equity in, I would say, two respects. One is we do a lot of work on companies just like private equity investors do, because we also have very concentrated holdings and we hold them for a long time. The second is our holding period is probably as large as a private equity investor because our churn in the portfolio is very, very low. The minimum we look at a stock is for 3 years. Say there's a stock whose next quarter numbers are good, but beyond that, we have no comfort. We'll not even look at it. For us, it starts with, okay, what is the 3 year outlook for this? And solely then that we go down to, okay, what do we think will happen over 1 year, 1 quarter, then 5 years? So, that is the way it's like what I call a quasi private equity approach to small cap. Because just remember here, liquidity is a constraint and, you have to keep that in mind. You can't keep buying and selling these stocks with every quarterly numbers or something. At the same time, we are not private equity because we have no access to non public information. So everything which we do is based on public information. We can't go, we don't sign NDA with companies. We can't do that as a listed equity investor. So unlike private equity, we don't sit on the board of companies. We can't influence policies also. So this is like, a quasi private equity investing in the listed space is the way I define, small cap investing. So I'm conscious of time, but I'll just spend some time on our investment process. So one of the differences I think in our process versus a lot of other people is that though we are also bottom up stock investors, we do have a macro overlay to a lot of what we do. So we call our process macro to micro. Essentially, though we do bottom up, we think macro is very important for our bottom up analysis also, and we use macro in two ways. So first is, when we do our bottom up analysis, all of us do some sort of earnings forecast for companies. I've used that there's some macro overlay there. For example, like 18 months ago, we decided interest rates will move up 300 basis point. So it was in all our earnings forecasts, we had a 300 basis point improvement increase in interest rates built in. And so instead of like changing that number every time interest rates went up, we had done it upfront. So we took a call that if some companies don't work out well, if interest rates go up so much, then we should not really be looking at them at all. Now, when we do this sort of macros, are we really fussed about whether it's 300, 275, 345? No, it was like there's a sizable increase in interest rates which are likely. So build that into our investment process. So that's one way we think of macro when we do our bottom up stock picking. The other is like if you see the screen, we use macro to really think of some stock ideas. And so, to give you an example of how we use macro, it is we try and think of what are the themes which will play out in the market, and is there some way to benefit in stocks from that. So, if I just go back a couple of years back when COVID happened, everything was falling all over the place. The one thing which was clear to me was that we'll have a fiscal and monetary stimulus. So for us, it was with the fiscal and monetary stimulus, what are the stocks and sectors which will benefit, and how do we gain out of that? So like we looked at a lot of government schemes which they were spending on. We picked up Harnal Jal because that was like one of the schemes which was having a huge allocation which came in the budget. And so it was, what can we buy to benefit from this? The government will spend on pipes, they'll spend on pump stations, there'll be contractors who build these pipes, and the pump stations will benefit from this. So we looked at various segments which will benefit from this. We ultimately picked up pipes, and that's something which invested, which in hindsight we know now like it was a great investment because we got a multi-bagger out of some of those companies. But some of the criteria we employed there was, the government will spend, and we hope we know and we can forecast that the government will spend. But you should always think of the other scenario. What if the government does not spend? What if COVID becomes so pronounced that the budget just doesn't have abilities to spend? So my thing was, if the government doesn't spend, let's do one scenario where they don't spend, and the other one is of course the scenario where they will spend. The other criteria which I have is, I generally don't like government to be more than 25% of sales. And the reason for that is, typically in government, the debtor days become very high. So even though you get your earnings, it messes up your balance sheet totally, and that always leads to deterioration in the return ratios. So we put that criteria when we did all this stock picking, and that's the way we went about picking up the pipe sector, which worked out very well. The other way we look at stocks is, of course, the most standard way, which is bottom up screening of stocks. So there's some screens which I think we do, which I think a lot of other people do, which is looking at companies which have high ROE, low debt, which are constantly showing improvement in margin profile. And those are stocks which are obviously good, and we want to own them also. Quite often, of course, we find them very expensive. So the reason is, it's well known, everybody knows it. So, to some extent, it becomes like, at this price, do we want to buy it? And the answer becomes no. But, I think our edge comes in doing something which is opposite of this, which is really looking at companies which are in temporary pain. So, when you go to the same screens, instead of looking at companies whose margins have gone up, we're looking for companies whose margins are the lowest in 10 years, or companies whose asset turnovers are lowest in 10 years. companies whose sales growth are lowest in 10 years. And the reason we are looking at it is if we can find companies which are in temporary pain, then we can identify triggers where the companies start to improve, their margins start to improve. We can make a lot more money because the risk reward is totally in our favor. So, for example, some of these screens lend themselves well. For example, if you look at, a company whose asset turnover is low today and the company whose margins are also low today, invariably we'll find that 80% of these companies have had a new capital expenditure which has come in. There's a new project which has started implementation. It's running, but it's probably running at low utilization. So that new capacity is actually making losses or making very low margins, and that is dragging down the overall margins. So for us, it becomes okay. Now we have to think this new capacity, why is it at lower margins, and can it move up from where it is to higher margins so that things improve. And that's why we find actually quite a few of our winners, because buying this, we found these stocks early, went deep dive into them, and then we were able to figure out what happened to them. So that is like the other way which we pick stocks. In terms of stock picking, we spend a lot of time. One is on meeting not just the management. We obviously meet the management 2 3 times, but my thought process is uh, basically we will look at the whole 360-degree of the company. So we look at dealers, suppliers, competitors, and we talk to everybody before we start going to uh, decide whether the stock is worth it or not. The second thing is, of course, we spend a lot of time modeling these companies, thinking of all the scenarios before we really buy it. And we also have a bit of focus on who owns the stock, who doesn't. We are happy to be actually the first ones to own the stock. So I know we are like overshooting time, so I'll just have one last thing on portfolio construction. Uh, like I said, liquidity is one of the big risks which we always have to think of. So what we think of really is there are 2 3 ways we try and think of the liquidity risk. The first one is we typically own a stock with 5 to 7% weight. Second is we don't let any stock become more than 20% weight. So even if you think it's a great stock because it's run up a lot and it by chance becomes 20% weight, we'll be selling that stock. Second is we don't own more than 3 to 5% of the company. So beyond that we will not go whatever happens, because that then restricts our ability to sell the stock at some point. Third is within sectors, we typically don't do more than 40% in any single sector and more than 60% in any 2 sectors. And this to me is high, like 40% is used to own in the sector. The reason we kept this 40 is, banks are like 35% weight or something in the index. So at some point when you overweight banks, you have to go closer to 40%. Otherwise, you'll never be able to overweight banks. So that is really how the portfolio construction is done. We monitor the companies quite a bit, but if we know, let's say next quarter results are bad, but we think that the next 3 years the prospects of the company continues to be good, then we will not really be selling the stock. Our whole thing is next 2 years, 3 years, is the growth outlook continuing or not, and in between you'll probably have 1 or 2 quarters where things don't turn out to be good. The stock also does not do well, but we'll probably be ignoring that and just going ahead. So that in a nutshell is one framework which is in front of you on how to do small cap investing. Probably it's like a tougher part. It's easier to do large caps than to do small caps to some extent, because here you need more patience, you probably need more work, and you have to make sure that you're able to pick the right stocks and the right management. So Kamal, I'll stop at that and probably we can take some questions.
Sure, Jyoti. I think the presentation was quite interesting. So the first question that comes to my mind is that if I try to put myself in an investor's shoe,
Yeah.
I would want to understand. I want to invest in the space of small caps, but where do we stand in terms of valuations? Say at the moment, we have seen overall markets in terms of frontline indices kind of closer to their all-time highs, though over last 1 month markets have shown some correction
Yeah.
in terms of say Nifty 50 and Sensex. But with regards to small caps, if one has to ascertain, where do we stand in terms of price to earning, or does price to earning really matter, and or how to assess, price to earning in the current context. I had run poll, and 67% of audience does believe that at the moment valuations of small caps are attractive. What's your belief? And kindly substantiate the same.
Yeah, so see, we had put out this one chart on the valuation. So basically, we tend to look at two things. So one is we look at valuations versus the large cap and what is the premium discount. So what you'll find over the period of last 8 years, 10 years is there are periods where the small caps tend to trade at a huge premium on a PE basis to the large cap valuations. There are periods when they tend to trade at a huge discount to the valuations of the large cap. Currently, they're trading at a sizable discount. The discount is around 32%. The peak discount has been 40 in one or two of these odd years. And the premium has been, it's been like a premium also. So in that sense, on a relative basis, they are trading at like quite an attractive discount, which you will get to the large caps. So on a pure valuation basis, it's very good. Second is in pure performance also. You want to get at them when they've underperformed for some time. So on a 5 year basis, small caps are now underperforming the large cap. Even on a 1 year basis, they've underperformed the large cap. So to that extent, both in performance as well as in valuation, they are looking attractive. So the reason I also said that you should stagger it over the next few months is that just now markets are very uncertain globally. Like we've had a good run, like you said, we are at a quite high in terms of just the large cap performance. Also globally, also we've had some bounce in the market, and Fed is all over the place. Do we get a recession in US is all over the place. So in these uncertain times, if at some point market does take a correction, and this is very typical, quite often it doesn't matter what the valuations are and how they've been, you do tend to see small caps correct more than the large caps. So for me it is like we have some powder dry that if we get this sort of correction, it helps us to make even more money in the large cap. But over the course of this year, my view is if you look at 23 as a whole, we'll probably see small cap do better than large caps.
Sure. So, if we do believe and convince ourselves that valuations by small caps are attractive and we want to invest in the space of small caps, we want to take that risk. Subsequent question that comes to my mind is that if one really sees long term returns, if you compare last 10-year returns, small cap returns and Nifty 50 returns are almost similar, if seen at index level. Even if one sees last 20-year returns, the story is same. It is ranging small caps, Nifty small cap 100 index or Nifty 50, if it is compared, returns are like 11, 12, 13. So the difference is not much. So when the difference over longer term is not much, why would you believe that over say next 5 years or next 10 years, like you mentioned, 2023, it should be more attractive for small caps? What makes you believe that?
Yeah, so Kamal, again, these were the first two slides which I had put out. So one is like, the returns differential is not much, but it's still higher. Like over last 10 years also, we've seen small caps give at the index level, give a higher return than, the large caps have given. It may be like just a 2% differential or something, but 2% compounded over 10 years does add up to quite a bit. So like if you see the first slide, it was 30 to 50% extra money could be made by doing in small cap. But I think the more critical point is not just what the index returns are. It's been like if we take any data, it's been very tough to generate alpha in the large caps. Whereas if you see most of the small cap funds, they've generated a large amount of alpha. Like we've done 11, means you may not be able to sustain 11 forever, but most funds should on average have generated like 5%, 6% sort of alpha over the small cap index. So when you look at total returns at the fund level, you'll find that the return differentials are quite high between the small cap and the large cap.
Sure, well put. Another thing that comes to my mind when it comes to creating a large cap portfolio, or if I was to do webinar with a multi cap or a large cap fund manager, and if we were to ask the top question is what are the favorite sectors, everyone says financial services is the top sector, and then followed by that, I think 1.5 2 years ago everybody used to like IT, and then consumer, So,
Yes.
and these are the three sectors, if one kind of sees in the descending order, Nifty 50 or Nifty 500, the top weighted sector is financial services and then IT and then consumer. Now, if one has to approach same question to somebody who's a small cap fund manager, and that is why this question to you,
Yes.
what are your top three sectors, and does when it comes to creating a portfolio, you consider sectoral allocation, or it is purely talking about thinking about businesses, and you do not think of macro or a sectoral perspective?
No, so frankly, we do consider sectoral approach. We do think of macro. So it's not like we are trying to do a index hugging or something. In fact, we run what I call a very, very active portfolio. So, if you look at active rate, basically, we probably have only 5% of our portfolio is there in the index, is there in the small cap index also. So to that extent, it's a very active portfolio. At the same time, we do think of macro themes which are there and how we can play it. Like I said, one of the reasons we bought pipes was this Harnal Jal which started. So for us, software is attractive space, consumers are attractive space, banks are attractive space, but it is also what valuations are there and what point of time it is there. So broadly, we have two themes which we have been playing with for the last 18 months. The first is we prefer domestic place to global place simply because we think there's a bigger risk of a global slowdown than there is of a India slowdown. The second theme we have is that the consumption sector will probably grow slower than the investment sector in India, and the reason for that is very counterintuitive to what most people believe. The reason for that is if you see the government budget and the government spending, a bigger and bigger proportion of their spending is going to capital expenditure and a lot less is going to revenue expenditure and salaries and the rural employment programs. And that's the reason, like, effectively the capital expenditure as a percentage of GDP has gone up 50% in the last 5 years from the government. And so, like, if you to think of this and you think also the valuation and performance, the consumer sectors from 2008 to 2020 have like been star performers. They've done very well. Most of the capital goods sectors are like not even where they were in 2008 in terms of share prices. Second is if you see the valuations, most of the consumer companies have seen their valuations go up by 50 to 80% between 2008 and now. So to that extent, that's been like a very broad theme which we have. And so, like our largest weights, banks is something which we like and we liked last year also, but otherwise other large weights are, linked to capital goods and infrastructure sectors.
So can you please elaborate by taking example of maybe in a couple of stocks? What was the thesis behind buying a particular company? For a better understanding of the audience, you could take it from financial services or consumer. Maybe two examples.
Yeah, so let me take something which I've already given, so that's easier. So, like I said, when we are into capital expenditure, capital goods, and infrastructure, one of the things which we own are the pipe companies, the steel pipe companies. So, there are two, three reasons why we own them. As infrastructure picks up, if you see these pipe companies, they're going into all the infrastructure projects, like they go into airports, and if you go to airports, you'll find that there are lots of pipes hanging all around and it has become a part of decoration piece also. So the whole spend in infrastructure is helping these pipe companies, and they are second thing what is helping them is the Har Nal Jal program of the government. So there are two growth drivers which are there, which are leading to a sharp growth in the volume for these pipe companies. The second thing is if we come to margins, these are basically converters. So they all get like a standard margin per ton of product which is been around 3,000 rupees. But all of them are trying to add more value so that they go to more value added products. They reduce the normal black pipe which they have so that the margins move up from 3,000 rupees a ton to 4,000 and 5,000 rupees a ton. So you get like one stable earning stream where the margins are moving up, volumes are also moving up. Third is there are a lot of players in the segment which are expanding capacity, so which will aid volume growth just given the demand dynamics. So you'll get a combination of a strong growth where the company's added to volumes. Second is your margins which are picking up. And so, that will lead to a sharp improvement in terms of your bottom line and your top line. Now, all of these companies used to trade at very low valuations till a few years ago. Now the valuations are no longer cheap. The valuations have become high. Most companies in the sector were trading at single digit Ps in like 2021. Now most of them are getting closer to 18, 20. So that same valuation kicker may not be there because all the last few years they grew because earnings also grew, and the valuations effectively also doubled. So my views from here on, you'll probably get valuations remaining more or less stable. You'll not get a big re-rating there, but you'll have earnings growth which will drive these sectors.
So over last 3 years, your clients have seen very decent, very high returns. But over next 3 years and 5 years, because of now the popularity and the past performance of Valentis, obviously you will attract maybe higher AUMs. And as AUM will grow, would this restrict the possibility of future returns? And if yes, what is the solution to that you have in your mind?
Kamal, I'll be hoping we don't restrict because I'm one of the largest investors in the PMS. So my returns will be the first ones to go down. But if you just look at since we started the fund, basically we did 11% alpha and we did a 18% return overall. Because the small caps did only 7% return. I'm hoping the next 5 years we could do a similar sort of return, but it probably may be a little less alpha and a little more help from the index, which helps us, so we end up with similar thing. Of course, our endeavor would be to still continue doing a 10-11% alpha and not reduce that also. Two things which we are trying to do, and that's why I like alluded to it in our fund, that at some point we have to keep thinking what is the optimum size of the fund and how do we really cap the fund. We may at some point shut the fund if we think that okay, we're not able to handle new money, and we'll cap it like probably at 800,000 crores. So it's not like we let it go to 5,000 in that cap. So that would be one other way we will try to protect the returns which really come in. But otherwise, we have to keep finding stocks. So that's the interesting part.
Hello?
Yeah, hi.
Yeah, can you hear me?
Yeah.
So, the subsequent, question that comes to my mind pertaining to investing in your portfolio is generally, as you mentioned, that yours is an actively managed strategy,
Yeah.
right? So, when the more churn happens in the portfolio, that really hurts and impacts clients. So, how would you kind of, define the churn in the portfolio historically?
Okay, so just one clarification. When I said actively managed, I didn't mean actively in terms of churning the portfolio. When I said actively managed, it is like, the active share is essentially what is not index share. So what is not in the index. So basically it is like 95% of the stocks we own are not part of the benchmark indices, the any of the small cap indices. So that's what we meant by the active share. So in terms of churn, our churn is low. We are very boring investors. We probably just sit on the same stocks for a long time. Our churn ratio across the last few years has been around between 16 and 18%. So whether you take a 1 year, a 3 or 5 year, is in that range. So typically, like effectively, it means our holding period of a stock is 6 years or something. So it's a very low churn ratio. In fact, if anything, clients just say you have a very boring fund where nothing changes. And sometimes people call us to, I hope you remember my money lying with you in the fund. I said, yeah, I can't forget. Even my money is lying there.
Sure. So apart from fund manager performing a good role in terms of not just identifying good businesses, but trying to be very disciplined in one's approach. What are the factors beyond fund manager that you think investors should keep in mind, or maybe investors should play a role in kind of expecting and actually experiencing returns like 8 times or 10 times in 10 years?
So, one of the biggest things I'll say is psychology of the investor. So, and that's true not just for small caps, it's true for large caps also, but it becomes even more important in small caps. So, I say, investing is 75% psychology and 25% intelligence. So, in small caps, you'll get large drawdowns which will come. You'll see your money down 40%, 50%. And when that happens, typically you start blaming the company. This is not a good company, it's fallen 50%. So, the companies, what it is, the companies good or not is not determined by the stock price. It's determined by his performance. So quite often the performance is improving and the stock price is falling. So don't get carried away by the stock price. Just focus on the performance and the returns will come. And we've seen it like when we ran the fund also. If we go back into recent history, 18 and 19 were very bad periods for small cap fund because there were a lot of changes which came. ASM, GSM, SEBI had some changes for the mutual funds on what they could do with small caps in a large cap portfolio. So a lot of small caps, most of the small cap funds gave a negative return. And by the time COVID came, if, like between January 18 to March 20, I think most funds were down like 40 to 50%. So that's where the patience comes in. That's where the psychology comes in, that this is not the time to withdraw. This is the time to add if we can, or just stay put. And then 1 year later we saw how all of them got a huge return. So I would say patience and psychology is the most important thing for investors.
Sure. So I'll ask you, one another question. So maybe this is second last question of this entire webinar, and this is a common question which comes to every investor's mind when it comes to, now we assume that by now investors are convinced, towards investing in the space of small caps. So they would have this question: why should they invest in PMS and not a mutual fund? Because there are various, I would say, popular schemes like SBI small cap, Kotak small cap, which have also done well in
Yeah.
the past. But what is the difference in PMS structure, or maybe what is more attractive about PMS structure? Your unbiased opinion over next, say, 5, 7, 10 years in this regards.
Yeah, definitely. So, like the critical thing is first you decide you want to invest in small caps, and both mutual funds and PMSs offer you attractive way to get in. So I'll tell you the only difference which a PMS has versus a mutual fund is the size. So, like I said, the smaller the size, the easier it is for us to buy really small cap companies because we can take a stake in it. One Generally most of the mutual funds are much bigger in AUM than what the PMSs are. So that inhibits. So it's not like they're less intelligent or they can't find the same stocks. It's just that given the AUM size, they cannot take part in any of the companies. Like we are certain size today, so we generally don't look at stocks with market cap less than 500-700 crores. In fact, we have only one stock in our portfolio less than 1,000 crore market cap. When we were much smaller, we could have looked at less than 500 crores also. So same way, as the mutual funds get to some size, they'll say we can't look at anything which is less than maybe 3,000 crores or 5,000 crores. So that is the one thing which inhibits them from really, it's just the size of the fund. The size also makes them have like 30, 40, 50 stocks. So if you see most of the mutual funds, they have at least 30 to 50 stocks in their portfolio. If you see most of the PMSs, they'll probably have between 15 to 20 stocks in the portfolio, which is partly a function of the size. So I would say most mutual funds will be lower beta. Most mutual funds in small cap will be lower beta than the PMS. They'll not fall as much when small caps do badly, but they'll probably not go up as much when the small caps do well, just because of the size restricting them from taking very extraordinarily large bets.
Come to the last question of this episode. When it comes to investing into PMS, investors always feel that their money will be managed more privately, more in a more customized way, because they're handing over this to a private fund manager. Right now, obviously, investor wants to know your vision, because we have seen many portfolio managers over years have been coming up with various schemes. Like there are many other PMSs and AIF companies, which begin with one PMS scheme, and then over a period of time, as they gain popularity, they come up with second, third, and then eventually they start with a mutual fund. And then obviously it becomes like, for that particular portfolio manager, there was a skin in the game, but now he spread his bets. If any particular kind of PMS or portfolio doesn't perform, it may not impact him much. So what is your vision? Because if any investor is giving you money, he's wanting to make that 10x over 10 years. It requires a 10-year time period. So investor also wants to understand, how do you see, where do you want to take Valentis? What is your growth plan? and how do you give comfort or conviction to the investor in this regards?
Yeah, so see, I think the biggest comfort I can give him is that my own money is here, and a substantially large part of my money is there in the small cap fund. So to that extent, every time it does badly, I'm one of the biggest investors. I get hurt the most. Now, obviously, from our point of view, we, like I said, at some point we are going to shut down the scheme for fresh inflows when we think it's becoming unwieldy. That number in my mind is probably something like 1,000 crores. It may be like 800, maybe 1,000, maybe 1,200 crores. So we will shut down. So that's one best way to ensure that we don't get inflows which are so unwieldy that we are not able to manage the returns and the returns come down. So that is one thing we do. We'll obviously have a second scheme which is the multi-cap, and part of the reason we started the multi-cap was the same thing, that okay, we have a track record. When you shut down this scheme, we may still need to have another scheme where people can invest in. But what we also try and do is, every time we keep getting inflows, like I don't take any salary from the company, I don't take any salary from the Valentis. So to that extent, the more money we make, the more we invest in people, the more we invest in trying to scale up the size of our operations. So we invest more in research, we have more research people, more fund management people. And so, that enables us to have much broader network where some people can focus just on the small cap, some on the multi cap, and some on bigger. Plus, the analyst team helps us to broaden and even cover more companies than we're doing today.
Thank you so much for your time, Jyoti. I will just sum it up for the audience. Current times, the valuations of small caps compared to large caps are relatively attractive. Investing in small caps is the only way to actually create wealth if one has to actually see something like 8 to 10 times over next 10 years. Last 10 years was a conducive environment, conducive, I would say, market for large caps. In fact, large caps became giant caps because it was a quantitative easing era. There was too much liquidity. A bigger picture is that US did better than India. US was a large cap, it became a giant cap. So this decade, which is ahead of us, is not a decade of quantitative easing, it's a decade of quantitative tightening. Hence, it is going to be an era of mid caps and small caps, and an era of maybe India over US, and within India, mid cap over large caps and small caps over mid caps. Because when liquidity is less, one tends to become more value conscious, and there is more value in the space of mid and small caps when it comes to selecting the businesses. But yes, it is not easy, it has risk, and hence it requires that discovery. And that is where comes PMS AIF World, where we try and do all these weekly discussions with fund managers to try and ascertain that what is right, what is not right, and we do that really well. We have a framework, quality, risk, and consistency analysis, which is further dissected into 9-factor model, on the basis of which we do analytics back quality investing for our clients. I kind of urge all of you who are keen to create wealth over long term to come to our platform, book appointments with us, and our experts will help you assess your own risk profile, as well as kind of guide you, assist you, and help you with regards to your investments. Thank you everyone for logging today on this Friday. Thank you, Jyoti, for your time. We'll again do similar webinar maybe subsequently after some time. Thank you once again.
Thank you, Kamal. Thank you, everyone, for logging in.